All right, this is going to be a trade recap of February 29th. And just so that you guys know that I know what the fuck I'm talking about, I'm going to show this entry on NinjaTrader Rhythmic Apex funded account. You can see here I bought, I know that's a little hard to see, but that's a 17,872 and 17,956, and I sold one at 17,974 and one at 970. So I basically caught like 100 fucking points, 150 fucking points on both contracts. So let's get right into it. So these are the concepts that you have to need to know. You need to know market maker models, the movement of how price books from ERL to IRL, how to use standard deviations, basic ICT concepts and PD arrays, liquidity concepts, understanding the draw on liquidity, running of sell stops, buy stops, accumulation, manipulation, distribution, the time-based aspect of an open, high, low, and close of a weekly, daily candle, the power of three, which again is open, high, low, close, your IPTA market cycles, basically how we move from expansion to consolidation, and we can't reverse from consolidation, and our protracted profiles. So let's get into it. The first thing I want to notice here is last week we create a daily fair value gap before we run out our daily stops, right? And we know that our daily swing highs are external range liquidity, and our fair value gaps, breaker blocks, order blocks are our, let me mark this out, are our internal range liquidity. But for sake of simplicity, I'm just going to refer to internal range liquidity as fair value gaps, BISIs, SIBIs. And let's mark out the mean threshold of this, and I'll even draw it out with a fib line. In terms of a liquidity matrix, or just drawing out your discount and your premium array levels, it's important to notice that in any PD array, or just price in general of a dealing range, price is going to move from discount, which is below the 50, to premium, which is above, or premium to discount. That concept is going to be essential to understanding why we reversed that Thursday and how we reversed that Thursday. So let's get right into it. Let's go to our lower time frame. So here you can see this is the point where the daily hit ERL, and we are now expecting it to hit IRL. One of the important things to note is our economic calendar, and also our weekly movement of price, how we chop down into this. So immediately starting from Monday, you can see that Monday, automatically we don't trade Mondays. As ICT concept traders, as liquidity traders, we don't trade Mondays. Any concept, it's generally safer to not trade Mondays, as Mondays are days where price provides information. So we can null void Monday out. Tuesday, if we were bullish on the week, if we were going to have a classic expansion week, Monday should have put in the low of the week, which you can see happened right here at 11ish p.m. or Tuesday here, right? And Tuesday should have expanded. So either Monday or Tuesday puts in the low of the week and we expand, but you can clearly see here that Tuesday puts in a low and then another lower low in the PM session, and we just kind of consolidate inside of the entire Tuesday day. So Monday consolidation, Tuesday consolidation, and we are bullish on the week because of our ERL to IRL. That's just how price books. So we are bullish. We want to see ERL again because we hit IRL. So Monday consolidates, Tuesday consolidates. We can now rule out our classic buy week. The only three weekly profiles we have left are Wednesday midweek reversal, Thursday consolidation reversal, and Friday seek and destroy. And actually, if you can already tell, the seek and destroy for Friday has already been ruled out. But let's talk about what happens after Tuesday. So you can see Wednesday, we kind of get a little bit of down movement, but we just end up chopping the entire AM session, the entire PM session, and it's just a total chop fest. Another day of consolidation. If this is going to be a midweek reversal, we should expect to see an SMT with ES or the YM, because SMTs qualify our smart money reversals at IRL or ERL in order to book price to the opposite direction. In this case, and I'm going to mark it out with you right now on the hourly, NASDAQ trades into the 50% level of the higher time frame PD array, which is on our daily BISI. And ES does not. You can clearly see that ES does not even come close to it. So if we draw out the swing low that's formed there with NAS, you can clearly see how ES's low is way further from NAS's. This SMT with ES qualifies our SMR from the discount of a higher time frame PD array, meaning that we have a lower time frame market maker buy model. And that is clear on the hourly. It is extremely clear that we hit this discount of the higher time frame. And the reason why I drew this H1 BISI in particular is because it was very close to the 50% range of the daily fair value gap, which means it's highly likely that this is the PD array that we can look off of for a 5-minute entry. Ideally, if we are following all the rules of the market maker model rules, you would have to wait for our hourly market structure shift, which we get after, and then an hourly retrace, which you also get at 11 a.m. But I'm going to explain to you right now that pre-news entry trade that I just showed you, where I caught 150 points on 2 contracts, and that shit is easy. That shit is very doable. We get 2 to 3 of those a month. You can literally make a living just trading those 2 or 3 times a month. So what I'm going to show you is the dynamic of after we get this SMT. And one thing I want to note is this devil's mark here. A devil's mark is basically a candle with no wick. And when you think about any candle in price, every candle has, let's draw this out really quickly. It's a little janky, apologize for that. But every candle is going to have an open, in a bullish candle's case, of course, a high, a low, and a close. Whether it goes up and then down first, or down and then up first, open, high, low, close, open, low, high, close, whatever you want to call it, every candle in general needs to form the low and then the close. This candle, or any candles without a low or a high wick, those candles are likely draws. They're called devil's marks. And that's just the name for them. And the reason why is because there's been a lack of orders being filled there. And as we know, smart money targets those areas. That is how they fill their stops. That's how they fill their orders. They target stops and they fill their orders. That's exactly how they book their price. That's how the market books price, because that's how they move the market. Apologize. Let's drop even further. So you can see here on the hourly, we have sell stops getting purged here during the London session. And then we have another swing low that purges more sell stops here. And an important thing to note is that these lows, this low right here at this 5 a.m. candle, is not ran on ES. I'll show you this right now. And it's a lot easier to actually see it on the 5-minute chart. ES never actually runs these lows. Let's here. If you look at this 5:45 a.m. low here and this 7:40 a.m. low, ES never runs the lows. And what do we know? Our smart money techniques, our SMTs, qualify our smart money reversals. Technically speaking, all of the conditions for a classic trade for the market maker buy model have not been met yet. But now this is where we can kind of incorporate our protraction profile. So let's take a closer look here. So if you don't know about protraction profiles, I highly recommend that you check out Afyz's or XYJ's Twitter, where he has a really great PDF on explaining these. But the main point of confluence for me was seeing that London protracted below MOP, which is basically the daily discount of the entire day's range, right? And you don't think of this in terms of a dealing range as per se as drawing out a Fibonacci or a 50% level, but just think of this as the daily discount, right? If we're bullish, we want to see London protract or manipulate below our MOP or our midnight opening price in order for us to take longs. And if you read the PDF that Afyz put out on this, if we see classic protraction, which is protraction from 12, or when London actually opens, from 1:30 to either 3 o'clock or 4 o'clock, you can expect continuation off a breaker. Or if you expect delayed protraction, which happens from 4 to 7 or even 4 to 8, you can consider a continuation up or down, depending on if you're bullish or bearish, off of a fair value gap. You can actually see here the entire London session manipulates below MOP. So I would take either one, but it's highly likely that I was following delayed protraction off of a fair value gap because of this BISI that I drew below. And this BISI is below the 50% dealing range of the daily fair value gap. Do you see how the concepts kind of start to blend here? So this was our SMT. The moment I saw this SMT, I entered one long position, one micro, and the reason I only entered one is because we didn't already get an hourly market structure shift. I was basically playing a preemptive news entry, and I had a lot of bullish confluences. That's why I entered my longs. My stops were going to be tight because this is a risk-on trade. A closure below this low obviously would have been my stop. You get like a fat 200 fucking point candle here, so obviously you are risking just getting ripped here. But again, when you're trading, you're putting on risk, and when you put on risk, you want to manage it and you want to take advantage of your edge. So that's exactly what I did. If I sized to win, yeah, maybe I could have won fucking 3 contracts, 200 points, however much money that is, I don't give a shit. But you need to size to lose, and that's how you stay profitable in the long term. Size to lose, because you're going to catch these all the fucking time. An important thing to note here, okay, maybe this still isn't enough confluence for you. Let's take a look again at our NQ chart, and let's take a look again at our ES chart. NQ and ES. Again, how do we qualify our smart money reversals? Through SMTs. Now let's talk about standard deviations for a little bit. And if you still don't know about those, I highly recommend you check out Afyz's Twitter. He has a great PDF on them. And he also has a lecture on his YouTube channel as well. We'll link that down below, so definitely check that out. So let's talk about how this high at 7 a.m. is not ran on NQ, but it's ran on ES. That's another SMT, which qualifies our SMR. And if there's one thing to know about drawing out your standard deviations, the highest quality standard deviations occur at SMT manipulation legs on your higher time frames, such as your hourly and your 4-hour. Look at the precision of this. The 4th deviation level lines up with the CE, or the middle, or the 50% level of the daily fair value gap, which we raid perfectly, and we do not close below it. It is high confluence that this is going to be the low of the week. This leg down is the manipulation leg that we get before we explode upwards. Now, another thing, if we want to frame the standard deviation levels for our weekly chart for the entire week, you're going to look for the place where we have a smart money reversal with our SMT, and you're going to draw it on the 4-hour chart because our time frame alignment is the weekly to the 4-hour. So if we draw our standard deviations from the last manipulation leg that forms the SMT inside of the higher time frame PD array, oh, would you look at that? Our -1 and the -1.5 level, which is our reaccumulation level, you can clearly see on the 4-hour candle that is exactly what happens, and we're going to zoom into that. But our -2 and -2.5 level, which is our reaccumulation, our second reaccumulation, or our reversal level, is right back at our ERL. And if we look at our concepts, we move from IRL to ERL. This manipulation leg projects the target for the rest of the week. Let's talk about open, high, low close concepts and time now, because none of this shit matters if we don't have any fucking time. Okay? Nothing matters without time. Nothing. Okay? Understand that, and you're going to understand why now. Again, Monday consolidates, Tuesday consolidates, Wednesday consolidates. And the important thing about this consolidation is that we induce this fair value gap by creating high resistance liquidity to the downside and low resistance liquidity to the upside, right? So Monday, no trade. Tuesday, no trade. We can rule out that weekly profile. Wednesday, no trade, consolidation. Thursday, it is highly likely. Again, let's look at all the bullish confluences. We're now in the discount. We had our SMT. We had the 4th deviation of Tuesday's manipulation leg. There's only 2 days left in the week, and we have to meet our weekly objective. How are we going to meet the weekly objective in 2 days? Price needs to explode. Price needs to fucking rip. And that's exactly what we get. That is the preemptive news entry. That is the amount, that's like 6 or 7 bullish confluence that take longs. You just can't be short. Even if you're not trading these concepts, if you're trading retail concepts, you can't be short here. You just can't. Again, I took my entry right here. I'll show you one more time. It's a little hard to see. 17,872, so right around here, I took my entry and I held it. Stop loss is closed below this. Fucking 200-point ripper. There we go. Now, if we're moving from daily IRL to ERL, our next swing point after trading into this IRL would be the most recent daily swing high, which is right here. Let's draw that out as well. Buy stops, right? At 840.25, let's drop to our 15. So I talked a bit about weekly profiles. I talked about our daily profiles. Let's talk about intraday profiles just for a little bit. If we hit our drawn liquidity, it is highly likely that the morning will reverse. I'm so sorry. The morning will continue into the drawn liquidity and the PM will reverse, or the morning will hit our drawn liquidity and the PM will continue after hitting the 50% discount of a dealing range or a PD array. This news candle, again, we talked about the midpoint of our PD arrays being hit and the importance of discount to premium. This is another example. I know a lot of traders, personally, who took this 5-minute market structure shift, because this is also an hourly. This is also an hourly fair value gap, right? And we have hourly to 5 and also 15 to 1. I know a lot of traders who either took this 5-minute market structure shift or they took this 1-minute market structure shift and they longed this and they got fucked because the market books from discount to premium. You would have had to wait through 11 a.m., through 10 a.m., through the rest of 9 a.m., all the way until 12 p.m. to get a 1-minute market structure shift and your entry. If you were patient and you waited for the discount, you would have caught from 17,922 40 points immediately. You get 40 points almost instantly. There's almost no, you get literally almost no drawdown. Almost no drawdown. Instantly, prices a ripper up. You get 40 points in fucking 5 minutes? Not even 10 minutes? That's easy. That is easy, but you need to stick to the rules and need to follow the plan. And the rest of the day, we kind of just spool upwards. There is one more day left of the week. Again, weekly objective is this all-time high. We have our -2 and our -2.5 levels there. And one last time, this was the trade entry for the week, for the day. Take this one trade and step away from the charts.